We want to show you something before we get to these bank earnings because it really matters here. To get an idea of stock market volatility, we just wanted to show you how the NASDAQ has closed over just the past 5 trading sessions. While the roller coaster ride may be rattling investors, what you see here, Tuesday, down 302 points. This is last Tuesday. Wednesday, up 51. Thursday, up 336. Friday, up 74. And then yesterday, down 408. That is rattling investors, but it sure is ringing the registers on Wall Street. The nation's top banks delivered record earnings today as market swings fueled a surge in trading revenue. As you see, JP Chase, Bank of America, and Goldman Sachs are all moving higher. Citigroup and Wells, they are in the red at the moment. Joining me now, RBC Capital Markets Managing Director and Head of Large Cap Bank Analyst, Gerard Cassidy. Gerard, these numbers across the board were stunning. They really were. But let's tackle the gains in equity trading revenue. Those are the ones that really stand out here. Goldman Sachs, we can put them up on the screen. Goldman Sachs came in with not just a record for its own equity trading revenue, but it came in for a record for the entire industry. So, I mean, to see that kind of thing, $7.42 billion in equity revenue. Can we put it up? I want our viewers to be able to see that. What does that tell you, Gerard?
Liz, it tells us that obviously the second quarter volatility worked very well for the trading firms like a Goldman Sachs. JP Morgan's number was also very strong. And I think what investors saw in the quarter was that due to the geopolitical risks and volatility created by the conflict in the Middle East, volatility really accelerated in the quarter. You also saw the Mag 7 and more recently the semiconductor stocks have amazing quarters in terms of how much they went up in the quarter, particularly the semiconductor stocks. And all of this contributed to incredible volumes on the exchange and activity. And also the use of derivatives comes into play here as well. And combining this all together with the financing of the equity trading, the prime brokerage business is very strong. It all led to these very strong numbers that you just pointed out for Goldman and its peers.
You know, this morning I'm sitting there and I'm thinking about the volatility and why listen, when there's a trade, whether it's up or whether it's a sell or a buy, you begin to see that this means money for all of the banks on Wall Street, and that's why they raked in so many. And we really shouldn't ignore Citigroup. They had a 45% increase in equity trading revenue, and Wells, 64% year over year. So very nice moves across the board. I said, let's look at the SOX and maybe the IGV, because the two areas that have been incredibly volatile have been, of course, the semiconductors, that trade, just all over the map, depending on the day, not to mention what we have seen for the IGV, which is the software. Do we have the 5 days here on those? Okay, so maybe we can put those up and we can get a sense of how they looked, because, Gerard, that's where a lot of the money's been made in this AI trade when it comes to semiconductors and, of course, software, which has been awfully volatile on the fears that AI would make it obsolete.
Right. No, you put your thumb right on it, Liz. Those are two areas that really have heightened the volatility separate from the geopolitical risks. And if that volatility continues, it will keep the revenues elevated. But we would point out, you know, the first and second quarters tend to be the stronger quarters in trading, because now as we enter the third quarter, the summer vacation season kicks in, and then you have the holiday season in the fourth quarter. So historically, seasonally, and Citigroup pointed this out on their call, seasonally they expect the second half trading numbers to be less than the first half.
Is that why the stock is down?
I think that for them in particular, it's more about expenses. They're investing more in their company for future growth. And I think that's what surprised investors today, was that the expenses in the second half of the year may come in higher than we had all anticipated. And that's, I think, it was weighing on the stock more so than having lower revenues from trading, which, again, most people understand the seasonality of the trading business.
We were listening to the morning call with Jamie Dimon because he's always interesting, and JP Morgan's CEO asked that same he kind of sort of rhetorically asked that question or mentioned it here. Here's what he said, and then I'll have you comment.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but how much better? I don't know. It's as good as it gets. We just don't know how long it's going to last.
He said it's getting close to as good as it gets. What happens when it hits that point and starts to maybe just retrace a little bit?
That's going to be the $64,000 question, because we should all enjoy these great numbers, but investors always look over the horizon. And when you look over the horizon, you have to ask yourself, can this elevated volatility and volumes and price adjustments continue? It's hard to envision that. Certainly it could happen, as Dimon just pointed out, but markets are cyclical, and we've been in a 3+ year bull market in equities, and at some point it runs out of gas. We're not suggesting it's going to happen anytime near term, but we always got to keep that in the back of our mind.
Let's talk about sort of these speculative bubbles. Not saying that's happening now, but saying that's happening now for a friend, right? I mean, listen, there are some areas that are getting extremely inflated here, and this actually, in a way, came up during Kevin Warsh's testimony before the House. This was his first testimony that he has made as Federal Reserve Chairman, and he was questioned about this by one congressman. Let's listen.
Can I have your assurance that you will be concerned about these speculative bubbles, Mr. Chairman?
So, Congressman, we want a resilient, strong, safe financial system, and we are looking at financial markets, and we're looking at the real economy to make sure we deliver on what we can. Some of these other subjects are really more in your purview and responsibility.
But they're in your purview, too, because you decide whether the rates go up or down. And if you lower them, then people can engage in these speculative bubbles.
See, Gerard, Congress remembers what happened in 2008, 9, 10, 11, the great financial crisis. They don't want to be the ones saying that they didn't ask about that.
No, very fair. And I would even point you to, Liz, 2020 and 2021. That's where the speculation also took place. Think about the residential housing market. Think about the average price of a house at the beginning of January of 2020 through the first quarter of 2022. According to the National Association of Realtors, housing prices went up on average 50% over 2 years, which is a bubble. But the prices haven't come down, and we're not suggesting they're going to collapse. But the Fed's actions, along with the federal government, to get us through the pandemic has flooded the market with liquidity. Fed's balance sheet, you might recall, going into the pandemic was about $3.5 trillion. Though it's come down from 9 at its peak, it's still $6.5 trillion. That's $3 trillion of liquidity that has to go somewhere, that's still in the market. And that doesn't even take into account the deficit spending the federal government did during that time period. And that's what's created these inflated assets. And Jamie Dimon has talked about this many times. That's one of his biggest concerns is inflated asset prices.
Yeah, he tends to raise the alarms, but I think it's important to note that Congress at least is trying to ask some important questions here. Kevin Warsh held up very well. Gerard, great to see you. Thank you so much.